Hey traders, what is up? Welcome to the most important Forex trading video you're ever going to watch. This is the most important strategy you ever need to know in trading, and that is your risk management strategy. I know, it sounds boring, but as traders, we need to be risk managers before we are profit takers. You can have whatever strategy you want. The thing is, the markets are random. The markets can do whatever they want. You can't control what the markets do, but what you can control is your risk. So, with that being said, here's the basic strategy. You need to risk a fixed amount on each trade. Okay? You need to look for a positive risk to reward. Positive risk to reward. Okay. That's pretty much the strategy there. Why do we say you need to risk a fixed amount? Because if you are risking different amounts on each trade, it's going to be much more difficult to make a profit in the long run. So see this scenario here, that is 2 losses and 1 win. But because you lost 70, lost 200 and only won 100, you then end up with $170 loss. If you have a fixed risk, and you look to make a positive risk to reward. So in this case, you're risking 1 to make 4. Here you have 2 losses and 1 win. You lose 100, you make 200, ends up with 100 profit. In trading, you should have 1 of 4 outcomes. You should either have a small loss, you should make no money, you should have a small win, or you should have a big win. You should never, ever, ever, ever have a big loss. When it comes to risk to reward ratios, obviously, the higher you go up in the risk to reward, so the more you look to make versus what you risk, the easier it is to be profitable. Now, what I mean by this, if you're risking $50 to make $50, you need to be right more than 50% of the time. So out of 10 trades, you need to be right for 6 of them. If you're risking 1 to make 2, you need to only be right 34% of the time to make money. So if you're risking 1s to make 2, if you're right for 4 out of 10 trades, you're making money, because if there are 6 losses, you'd lose 6R or 6 times your risk, and then you would make 4 times 2R. So you end up with 8R. So you have 6R loss and a 8R win, which ends up with 2R or 2 times your risk in profit. And the same story obviously goes on further down, where if your average is a 1:3 risk to reward, you only have to be right 25% of the time, and then 1:4 risk to reward. You get the idea. That's 20% of the time. If you have a strike rate that's anything higher than 20%, you make a profit. Now, practically, what does it look like to control your risk? Let's get into another chart here, and I can show you an example. Okay, so here we're on a new chart. The basic principle here is that your position size should change based on where your stop loss is. So if I'm taking a 1 lot trade on a 10 pip stop loss, I'm going to be losing $100 if my account is a dollar account and I'm trading like Euro USD or GBP USD or Aussie dollar. It'll obviously change a bit. This gets a little more complicated, so I'm not going to get down into this, but your rates, your pip value differs based on your term currency. So if you look at this is USD JPY or the dollar yen, and your pip value is determined by your term currency. So your dollar here is your base currency, your yen is your term currency, and your pip value will be determined based on what your trading account is in and what this term currency is. But I'm not going to get into that today. I'm going to show you guys a very simple way to manage your risk. There are some amazing tools out there, and especially on TradingView, there's like a really easy indicator you can use. Speaking of indicators, you go to your indicators, you type in position size calculator. This Forex position size calculator by Bullcatcher JC. Give that one a click. Give it a like. Did I just click the wrong spot? Put it on the chart, and it basically pops up with a menu like this. So what you'll come in here and you'll do is you'll set what your account currency is. For me, it's dollar. Let's just say you're trading a $5,000 account and you want to risk 1% per trade. Okay, so your pips at risk is going to change based on the trade. If I'm risking 1 lot and it's a 5 pip stop loss, I'll end up losing, let's just say this is GBP USD. Okay, so GU. If I've got a one lot and I'm risking 5 pips, each pip is worth $10, which then means that I've got $50 at risk. If I'm using a one lot and my stop loss is 10 pips away, each pip is still worth $10, which means that if this trade goes south, I'm losing $100. So what you need to do here is you need to obviously look for a position, see where you want to enter. Let's say I want to buy, I think price is going to go up. I don't actually think price is going to go up, but for argument's sake, let's just say price is going to go up and you're expecting price to take out these highs. Okay, so what you're going to do here is you're going to mark up your position, obviously before the time, because you should have an idea of where you want to enter in the market. So you put your stop loss where you want to put it. Let's say I want to put it below this low and I'm aiming for the top here. I can see my risk to reward is a 1:3.7-ish. And that's enough on the table for me to enter. I'd enter a trade that's got that, provided that the trade meets my criteria. So I have to set criteria before entering. Now, what you're going to do here is you're going to look at the stop loss pip amount, which is 14.2 pips. You'll come into your lot size calculator. You put in 14.2 pips, hit OK, and it'll tell you what lot size you should take. So on my $5,000 account, I should take a 0.47 lot trade for this trade. So if price comes, taps me in, starts moving up and takes me out, I then only lose $50. If I were to be risking more, sure, obviously that'll change, but the idea is to manage your trade so that when you lose $50, it's a set loss. And then if I were to win this trade, I'd end up making, what's that going to be, like $170? Should probably actually just get a calculator out. That would help. Okay, so $50 times, was it 3.7? Yeah, 3.7. 185. Okay. So if I win this trade, I'm making $185. If I lose the trade, I'm losing 50. But if you don't control your risk and if you don't set a lot size that is appropriate for this trade, you could end up losing $200 in this trade. You could even lose your entire account in one trade, and that's not what you want as a trader. What you want as a trader is you want to have an edge over the market, and that is your risk management strategy. And obviously, it's the same for sell trades. It's literally the same concept. The thing you focus on is how big your stop loss is. So if your stop loss is 10 pips, your position size is going to be smaller than if the stop loss were 5 pips. It's that simple. Okay, so if you guys have any questions, feel free to drop them in the comment section below. Follow us on Instagram at fxwealth.io. You can join our Discord. There's quite a few ways to get a hold of us. We're happy to help you guys. The whole aim for us is to build a community of profitable traders. And the only way you're going to get profitable is if you manage your risk. So your strategy is less important than your risk management. It's that simple. So anyways, I hope you guys enjoyed the video. Happy trading. Make sure to control your risk. That's all you can control. And I'll catch you guys in the next one. Cheers.